Okay, so I'll say their names, François Guriot and Michael Michaud. And I really, someone had to. So I enjoyed reading this paper. This is right up my alley, and it was, and I think it's an interesting addition to the literature, and I'll tell you why. So, wait a sec. So they want to answer two questions. There are two apparently contradictory facts in the data. The first fact is that if investment appears to be not very correlated with movements in Tobin's Q, so it doesn't respond much to equity values. And on the other hand, it appears to be very highly negatively correlated with credit spreads. And so one wonders how, at the same time, you can have investment that moves with the bond market but not with the stock market. So what's going on here? That's one of the main questions they want to ask. And how do they do that? So they're going to calibrate a model. And it's a very standard model. So it's a dynamic, discrete time model of financing investment. The firm has two choices every period. It walks into the world, and it picks its capital stock and its debt stock, and then it updates and goes forward. So it's a very standard setup. Now, one problem is it's a very simple model with just one-term debt, one-period debt, and non-stochastic volatility won't help them with their question. The model and the data don't seem to get along very well. However, once you stick in long-term debt and stochastic volatility, you can get the credit spread correlation, and so that's very nice. However, in the model, they say that even if they add all of this stuff, the model says that investment and Q are highly correlated, and yet in the data, the correlation's still pretty low. So they don't get a lot of mileage along that dimension. One dimension in which they do get a lot of mileage, though, is that the model produces realistic credit spreads. And so what I want to do in this discussion, I want to very briefly outline the model in a very different way than François did. I want to spend a lot more time explaining the intuition about how this works, and then, of course, provide a couple of suggestions. So the model has many ingredients on the real side. Some of them are I know about. So it has a concave stochastic production function that uses only capital. And there's investment and depreciation. So the firm not only invests to replace depreciated capital, it invests because there are productivity shocks. That's standard. Then there's some other stuff. So they have this fixed cost of production. I think that plays a big role in the model. I'll talk about that later. They have irreversible or partially reversible investment. I know that plays a big role in the model, and I'll talk about that later. And then they have these two volatility regimes. So there's the standard setup. There are the little extra doodads that they've added onto it, and those actually help get the results that they do. And I'll explain why in a bit. And then the model has many financial ingredients. First, there's a pricing kernel. So this takes it beyond any sort of standard corporate finance setup where we think that pricing kernels don't exist, which is a possibly not great assumption. The firm issues long-term debt, not short-term debt. And how is long-term debt modeled? The firm repays a constant fraction of the principal every period, and so it decays geometrically. Now, equity issuance or distributions are a little bit interesting in this type of models. So they're literally sources minus uses of funds. So what are the sources of funds? The firm sells stuff, and it also gets cash when it issues bonds. Those are the sources of funds. What are the uses of funds? It buys capital goods, and it repays its debt. It also pays taxes. So if sources minus uses is positive, the firm dishes everything out to shareholders. And if sources minus uses is negative, the firm gets a little bit of extra dollars in from the shareholders, but at a premium, and there is a linear cost of equity issuance. So we've got the real side, the financial side, and then, as I said, the firm just maximizes the present discounted value of equity holders and picks debt and capital. So that's the model. But the model also has endogenous default. So when the firm defaults when equity value is less than or equal to 0. And one thing that makes this model extremely hard to solve is that in bankruptcy, the equity value really is less than 0. And if the bondholder had any sort of bargaining power, they could extract some of that surplus. But in this model, they don't. So the equity holder's value is just set to 0, and then the firm dies. Okay. And this kind of model is very, very, very hard to solve. So I don't know how to do that. I can do the one-period debt one. I don't know how to do the multi-period debt one. And so kudos to the authors for figuring that out. That's a tour de force. That was good. So it's very hard to solve, and they figured it out. That's nice. So how does this model fit into the literature? So That's not a typo, that's 7, not 5. So it's like our old paper, except it has a pricing kernel, long-term debt instead of short-term debt, stochastic volatility, and then this other investment stuff and the fixed costs, so some other stuff around the edges. Or you could think of it as Gomez and Schmidt with long-term debt, stochastic volatility, and some other stuff. And like I said, I'll talk about the other stuff and how that plays a role in the model. Okay. So now I want to talk about what makes the model tick. And I think the best way to understand how any of these models work is to start with something super simple, understand how the super simple thing works, and then add features. So let's start with something that's pretty simple, which is the paper I did with Christopher in 2007. And so what we have here on the vertical axis is credit spreads. And yes, that is 120%, but that's only for a tiny, tiny fraction of the firms. And here we have leverage. So over there you're far from default, and up here you're very close to default. And as you can see in this kind of model, mostly credit spreads are 0. They're almost always 0 unless you get really, really close to the default threshold, and then they skyrocket. And so that gives you very low credit spreads. Now, to understand this intuition a little bit better behind how this works, we have to go back to 5 model features. So let's do that. There's this sources of uses and funds identity in the model, and this sets it apart from, say, the Merton models or the Leland models, and that really drives a lot of the action, because you have sources minus uses of funds, and the only thing that's moving that around is the shocks to the production function. And so that drives a lot of action in the model. We'll come back to that. External equity financing is costly. And the value function, it turns out, is almost linear in all the financial dimensions. It's got curvature in the capital dimension because everything's nice and smooth. But in the debt dimension, it's very flat. So if you put a tiny little equity issuance cost onto a decision that doesn't have much curvature, you get a lot of action. And what happens is the firms really don't like to get near that default threshold in this model. And so because of that, they spend a lot of their time in the region where credit spreads are 0. And so that's why you get, in these vanilla models, these very, very, very low credit spreads. And everybody's risk neutral. So now let's go back. And what's going on here is that because these firms really don't like to have to access these external equity markets, that's extra costly, and they want to, so they conserve debt capacity, and they mostly live in this area unless they get a whole bunch of bad shocks, and that'll dump them over here. But that happens very, very rarely. So the vanilla model won't get you credit spreads, and of course it won't get any correlation with credit spreads because the credit spreads don't move. Okay, now let's add a dimension. You get a pricing kernel. That doesn't give you much action, and the reason is in the model without the pricing kernel, the only reason why there are credit spreads is because bondholders don't get all of their payments in default, and they need to be compensated. With the pricing kernel, not only do the bondholders not get all of their payments in default, but it makes them bummed out, and so they need some compensation for being bummed out in those bad states of the world. But that, with the CRA pricing kernel, that just gives you a little bit of extra oomph. It doesn't give you much. So what gives you the oomph in this model is the stochastic volatility. And so what happens there, and the intuition there is very familiar, is that if you add stochastic volatility, you can increase volatility in some states of the world without increasing total volatility. And what happens there is that when you increase this volatility in some states of the world, you increase the option value of defaulting. And that's a fairly large effect in this model. And so that's going to give you the credit spreads. That's what bumps this thing up. Of course, the other thing that will do it all by itself is long-term debt. And what's going on there is that long-term debt reduces rollover risk, but it increases agency costs because bondholders don't know how much debt the firm is going to issue in the future. They don't know if the firm's just going to run itself up against the default threshold, and they want compensation for that. That's a big effect. If you put the two together, not much. And so I think what's going on, and I'm not sure here because like I said, I can't solve this model. I think what happens is it's the rollover risk versus agency cost. So if you have both stochastic volatility and long-term debt, the rollover risk outweighs the agency costs. And so if you put those two together, not much else happens. So one helps, all by itself. The other helps all by itself, but you put the two together and not much helps. Okay, so the investment credit spread correlation he went over very well. I'll just talk about it briefly. So if you add stochastic volatility to the model, third bullet point, that helps a lot. So why does that happen? When volatility is high, credit spreads are high. But from an ancient argument from Bernanke, when volatility is high and you have irreversible investment, the investment goes down. And so that's what makes that negative correlation happen in the model. And now I'm going to give them 3 comments. I actually think investment is plenty highly correlated with Q. It obviously is in the model. And why is that? They're big income effects. You have this one shock that drives everything. And so you get one shock that drives Q, it drives investment, and so yes, they move together. In the model, in the data, it's hard to compare Q in the model with Q in the data, because Q in the model is these investors with CRA utility valuing the firm. We know for at least 25 years that CRA utility doesn't work all that well. And so Q in the model has very little to do with Q in the data. So I've been playing with this question for, oh gosh, 20 years now. That's disturbing. So I actually it is disturbing. So I've been playing with this question for 20 years. I think that this discrepancy between model Q and data Q can be thought of, at least allegorically, as measurement error. If you use econometrics to fix that problem, the between Q and investment in the data is pretty high. R squared, is about 30 to 40%, and in corporate finance, 30 to 40% for an R squared with no fixed effects is huge. So I actually think that's good for the authors. They should just get rid of that part of the paper. They're good to go there. Their model does a good job with that. The model parameterization is very strange. They have this incredibly highly curved production function. This is way less than anything I've ever seen, and what that does is it means these firms aren't profitable. So I think that's helping them a lot with the default decision. They also have this fixed cost of production, which, given that the firms are not very profitable in the first place, makes them even less profitable. I also think that's helping with the default spreads a lot too. And that's very non-standard. I haven't seen that anywhere else. They have huge linear costs of equity issuance, 25%. So what are SEO fees? Something like 2%? So this is way, way, way off. And then deadweight default costs, those are not recovery rates. Those are payments to lawyers, are huge. They're 50%. We think from, say, Andrade and Kaplan, they're maybe 10 to 20%. And so those are very, very, very high. And I want to know if that's driving the results. I think that would be important. So I suggest, oh, and then one last thing, the model parameterization is fractured. They get different moments to match from different studies, and the different studies use different data from different time periods. And so what I would like to see them do is take the model more seriously and do a little bit of stress testing on it. So first, get a better pricing kernel. It's linear. We know there are nonlinearities in pricing kernels. I bet that would help them a lot. You know, use the data, get a decent pricing kernel. Step 2, I would actually try to take the model more seriously and see just how many features of the data it can match. Start with a simple model. See where it screws up. Add a feature. See where it doesn't screw up. And of course, once you see where the model fits the data and doesn't fit the data, you learn a lot more about the economics of the question. And so I think that doing this in a sequential fashion would teach us a lot more about how the model and the data work together, and that would help us a lot understand the problem. And then pay attention to investment dynamics. That's what drives everything. I've played with this stuff for almost 10 years. That drives everything in these models. If you have smooth investment, you get one thing. If you have lumpy investment, you get another thing. If you have irreversible investment, you get something else. So I would fix that, and I would pay strong attention to that. And so the conclusion, I think this is a paper with a good deal of potential. I would actually steer the focus in a different direction. You've got the credit spreads. This is a nice model of credit spreads. It opens the black box of the Merton models. That's great. And I think you should spend a lot more time on the intuition. And that's it.